The US is pumping more oil than ever, just as global prices face a serious test. The EIA now expects US oil output to climb even higher this year, despite growing warnings of a global supply glut that could hammer prices. At the same time, OPEC Plus is treading carefully, announcing only a modest output hike for November. Cracks are starting to show in the alliance, and even oil bulls are getting jittery. So are oil prices about to lose their floor? Naveen is a senior oil analyst at Kpler. So Naveen, OPEC Plus went with the smallest production hike on the table. Are we finally seeing oversupply fears creeping into the cartel's thinking?
That's maybe a little bit far-fetched for now. I think we're still in an environment where, as you mentioned, there are fears of a global glut, and nonetheless, they have increased their supply. Still a strong signal they've been sending. Internal discussions showed that they weren't even debating the more accelerated outputs that some of the media reports before the meeting suggested. I think they are still taking a very measured approach. They're looking at how supply and demand and the live data every month sort of presents itself before taking the next decision.
Well, Saudi Arabia appears determined to claw back lost market share. How far could that push OPEC Plus ambition, even at the risk of crashing prices?
So it is a balance of, clawing back market share, but also making sure that the other members within the group are comfortable with how the price progresses in the path to reducing spare capacity. Overall, I believe Saudi Arabia won't act unilaterally. The group as a whole wants to bring down spare capacity to close to 2.5 to 3% of global oil demand, close to where it was in the early 2000s as well. So that leaves us at about 2.5 to 3 million barrels a day of spare capacity, say. So on the path towards that, we are seeing this gradual unwind, and that will naturally lead itself to greater market share for Saudi Arabia.
Russia, meanwhile, pushed for a price defense strategy. Is that a sign that they're nearing production limits under the weight of sanctions?
It's a combination of the sanctions biting on the costs of investment and maintaining their upstream, but also the attacks from the Ukrainian drones, not only on the downstream refining sector, but also plugging out some of the port facilities as well. So effectively trying to shut in Russian supply. I think moving into the winter months as well, these costs for maintenance will become even more prohibitive. So something to look out for. Again, price will help support the Russian economy and the ability to invest and maintain upstream. But we do think as a whole, their upstream capacities have been hobbled because of sanctions and the Ukrainian drone strikes.
Let's look at China, though. It's bought over 150 million barrels more than it's consumed this year. What's driving that stockpiling, and could it suddenly stop?
Maybe a move to move away from US treasuries to diversify their assets, whilst also looking at the longer term. As mentioned previously, OPEC's aim seems to be to reduce spare capacity going into 2026. We also then see maybe natural field declines from non-OPEC oil producers. So coming into a world where there is lower spare capacity and the potential for a price floor as a result of that, China stockpiling oil potentially gives them a better lever and a better handle on the demand side to play with prices, I suppose, we get into that longer term, maybe second half of 2026 horizon. So multifaceted reasons for the China stockpiling, but potentially with a longer term aim there as well.
Meanwhile, back in the US, drilling activity slid through Q3. Is President Trump's drill baby drill mantra a lost cause?
So for now, US supplies remain robust. I believe the drill baby drill mantra will continue, especially with the gains in offshore oil production. But looking at the cost basis for some of the producers will be key to see how oil production progresses into next year.
So finally, Naveen, the EIA sees WTI averaging at $65 this year, but the White House is aiming for $40. Where do you see prices landing?
I think the two key factors here, as mentioned previously, are what happens with Russian supply and what happens with the nature of Chinese buying. Chinese buying, has the stockpiling is sort of stopped in September, but as we mentioned, there's an expectation for it to continue. So these are the two main catalysts that will dictate price, we believe. But these are very difficult factors with a lot of uncertainty around it. I think what's really baked into this has been a lot of trader fatigue around the uncertainty and volatility of this year. So technical trading ranges, statistical bands have also been very, very crucial. And as a result, flat prices stayed in a narrow band. So combining all these factors is why Kpler still sees WTI prices nearing the $60 level and hovering around there for the remainder of the year.
That was Naveen from Kpler. Don't forget, you can watch more videos on Reuters.com.